Kia ora, and welcome to Tuesday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz, and today we lead with news. Financial markets are running positively, but without the guardrails of American economic data, while the US federal shutdown extends. In their absence, consumer and tech speculations are generating considerable froth. But first in China, their mid-autumn festival holiday spending should tell us a lot about their economic activity, and the initial signs are promising for them. Unprecedented travel levels, active holiday destinations. But we'll have to wait for the overall outcomes. The final day of this holiday period is tomorrow. In Japan, their stock market took off in a wave of euphoria following the vote to make Sanae Takaichi the leader of the LDP and Prime Minister in waiting. But the yen fell, probably a boon for Japanese exporters. In Europe, August retail sales volumes were mixed. They were up only 1% from the same month a year ago, the least in more than a year. But the change from July was slightly more encouraging, driven by food purchases, especially in France and Spain. Germany and Italy were laggards, however. Easing fuel consumption was part of the reason for the retail growth restraint, which they will take as a good thing. In France, the newly appointed Prime Minister resigned when his new cabinet could not survive its first parliamentary vote. In Australia, the Melbourne Institute monthly inflation gauge recorded a 0.4% increase in monthly inflation for September from August, primarily influenced by higher recreation and transport-related prices. The monthly cost of living also rose. Annual headline inflation now lies at the top end of the 2 to 3% target band, at just on 3%. This is the same as the last ABS inflation indicator for August. At this rate, it seems unlikely that the RBA will be looking at any rate cut at their November 4th, 2025 review. But not everyone thinks like that. The central bank is still expected to slash its cash rate despite these sticky prices, according to the latest quarterly survey of economists by the Australian Financial Review. In the US, no progress at all on their federal government shutdown. And to distract attention, as autocrats always do, Trump is moving to impose National Guard military presence in major cities, even when the evidence is clear there are no crime waves, as he claims. But the distraction is the point. And we should note that aluminium prices are rising significantly again, up to $2,720 a tonne. They are now near their highest ever, apart from the unusual 2021-22 bubble in the pandemic recovery. Tin, zinc, and even copper are also on the rise. The main metal price not changing much is nickel, and iron ore price is also flatlining as it has done since early 2024. But precious metals, the ones much more subject to consumer speculation, are surging. The most spectacular is platinum, which is up 60% since May. In the same time, gold has risen 22% and silver 47%. The US Treasury 10-year yield is now at 4.16%, up 4 basis points from yesterday at this time. And the price of gold will start today at $3,952 an ounce, up $67 from yesterday, and a new high and powering towards $4,000 an ounce. Silver is up too, but less, now at $48.50 an ounce. And American oil prices are up $1 at just under $62 a barrel, while the international Brent price is just on $65.50 a barrel. And the Kiwi dollar is now just on 58.4 US cents, up 10 basis points from yesterday. Against the Aussie was soft by 10 basis points at 88.2 Australian cents. Against the euro we're up 20 basis points at 49.9 euro cents. That all means our trade-weighted index starts today at just under 65.7 and up 10 basis points from yesterday. And the Bitcoin price starts today at $125,294 and up 2% from yesterday. Volatility of the past 24 hours, however, has been modest at just on plus or minus 1.1%. You can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.